Hello everyone, I am Kavya Sen, studying at SPCE College of Engineering, semester MBA first sem, subject code MBA 102, subject financial accounting and reporting, topic generally accepted accounting principles. Now let me discuss about the GAAP. What GAAP full form generally accepted accounting principles, meaning of GAAP. Generally accepted accounting principles are the basic accounting principles and the guidelines which provide the framework for more detailed and comprehensive accounting rules, standards, and other industrial specific accounting practices. Now let me discuss about the principles, generally accepted accounting principles. Business entity assumption. It states that every business entity should be treated as an entity that is separate from its owner. Therefore, all the financial transactions should be also distinguished in such a manner. The concept is especially important while recording the financial transactions of the sole proprietor. When the entire business with its assets liabilities belonged to the proprietor, the financial transactions need to be distinguished between those related to the business and those related to the proprietor personally. Monetary unit assumption. All the financial transactions of the business should be capable of being expressed in a monetary unit. And if it is not possible to do so, then it should be not be recorded in the books of accounts of the business. Accounting period. These principles entails the accounting principles of the business should be completed within a certain time period, which is usually a financial year for the accounting. Those every transactions which is related to the particular accounting period will be recorded. Financial statements prepared for the period. Now, historical cost concept. As the general rule, when the certain economic resources or assets are acquired by the enterprises, then are the recorded as per the cash equivalents actually spent to acquire the resources or the asset and the transaction date, even if the transactions happened the previously day or 10 years ago. The would result in the value of remaining asset constant, irrespective of accounting period. The market value of the asset is not taken in account unless specifically required by the law and accounting standard. Going concern assumption. The business entity is assumed to be a going concern. It will be continued to operate for an indefinite amount of time. This assumption is important because if the business entity were to be liquidated in the near future, it would have to restore its assets liabilities in the accordance with the actual amount that could be realistic as the case may be, so as the reflect the true financial position of the entity. And full disclosure principle. An accounting entry may not independently be able to provide all the relevant information related to the transactions. Hence, the full disclosure principle requires the entity to disclose all the financial information relevant to the investors, users to assist them to in decision making. At the transaction level, this is done by the recording and advocate narration with every transaction, and at the financial statement level. This is implemented by providing the notes of accounts. Matching concept. This concept requires the revenue for the particular period to be matched with its corresponding expenditure so as to show the true profit for the for the period. Accrual basis of accounting. The principle requires all revenue and expenditure to be recorded in the period it is actually incurred and not when the cash and cash equivalent has been received or spent. The earning of the income and incurred of the expenditure has irrespective of the corresponding cash flow. Consistency. An entity may decide to follow a particular accounting procedure in relation to a series of transactions, such as accounting procedures need to be followed consistently over the following accounting periods. so as the facilitate comparison of the results between the two periods. For example, an entity might choose a adopt to the straight line method of depreciation of its tangible fixed assets. This method needs to be consistently followed even in the coming years. Materiality. This accounting principle allows an entity to discard another accounting principle if the result of the same does not affect the decision making of the user of the financial statement. Certain errors or omissions may also be ignored if their effect is immaterial to the financial statement. For example, when a fixed asset is purchased, the matching concept requires the entity to recognize the expenditure over a useful life of asset. If the entity purchases a keyboard for 300 and the turnover of such a entity in the crores of rupees, it would be immaterial to the user of financial statements whether such an asset is recognized as an asset or expenses, those even the computer keyboard is considered as a year of purchase. It would not be volatiling the basic accounting principles, violating the basic accounting principles involved, and the impact of the same in conservatism. In the process of accounting, one may come across various situations where there are two equally acceptable ways of accounting for a particular transaction. One might even have to choose between recording a transaction or not recording the same. In such situation, a conservation approach should be followed. This means that while accounting for a particular transaction, all anticipated expenses or losses will need to be accounted for, but all the potential income or gains should not be recorded until actually earned or received. This is why a provision for expenses like bad debts is made, but there is no corresponding record provided for an increase in the realizable value of an asset. Thank you.